Happy February 5. My name is Jessica Amir, a market strategist here with Moomoo. It's great to have your company. So the S&P 500 is down again, now down 1.7% from its Jan record high amid the continued software sell-off. It's hurting the Nasdaq 100 definitely too. It's now down about 5% almost from its January high. All software stocks are getting hit with a very ugly stick indeed. That's the case. In Hong Kong, that's the case. Same tune being played out. Their major tech ETF is also down in the gurgler. Aussie's tech sector also getting pressured, down 9% this month. Nvidia's Jensen Wong said, "What the heck? The software sell-off is the most illogical thing in the world." That's what he said. But the technical indicators, they would suggest more downside could be ahead before markets potentially swing back up. That looks like it could be the case for the technical indicators for the S&P 500 and the Nasdaq 100 though. But software stocks, they are on the nose, continuing to come under pressure. The IGV is obviously the software iShares Expanded Tech ETF, the biggest tracker of software names. That is reflecting the fact that these software names are obviously in a very ugly bear market, down about 30% from the October high. But it's not just software stocks that are getting hit, so too are stocks that obviously disappoint earnings and outlooks. That's the case for AMD. AMD shares down 17% overnight. That was their biggest one-day drop since 2017. Obviously, no one likes the news that a company is going to slow down earnings, and that's why their shares are on the nose. But there's always a bull market somewhere. Healthcare stocks, they're shining and surging. Amgen overnight, in case you missed it, their shares hit their highest level in history. Eli Lilly popping like it's hot, almost 6%, surging near to its record all-time high. Obviously, Eli Lilly is gaining a lot of market share on the back of their GLP-1s, their weight loss drugs that are being used for obesity, but also importantly as well, is equally perhaps important, diabetes. The thinking is, based on what Eli Lilly said, they're expecting sales to grow 27% this year. That's great news and a very, very stark contrast to Novo Nordisk, which is why if you look at Novo Nordisk shares, they're down almost 70% from their record highs. They're near 2022 levels. So for more on all the weight loss drugs, have a look at the theme on Moomoo's platform. Just head under investment themes, and then that's in the US market section. What else do you need to know in news? Well, gold, silver, and copper, they're attempting to head back on up. Speaking of heading up, critical minerals must be on your radar in 2026. They should indeed be on your investing radar if they're already not, because this space is going to get a lot spicier and it could spice up your investment returns. So what do you need to know? Well, Trump basically announced a very red hot aggressive plan to buy and secure critical minerals. It's called Project Vault. He announced this back on February 2. And it's basically to ensure the US has got a strategic national reserve of key commodities. Remember, we've heard the term strategic reserve before. We do know the US has got an oil strategic reserve. So here are 5 things that you need to know exactly about this critical strategic reserve, Project Vault. Let's kick off with the basics. So the US is planning to buy at least 12 billion US dollars of these commodities, and that's enough to tighten an already very thin critical minerals market, which we know has got finite supply, meaning key commodities are going to see rising demand while supply is already finite and thin. This basically implies that prices could move a lot higher. The second thing you need to know is that the US has put together a hit list as top priority purchases. And what are they in commodities that you need to consider? Well, there are a few ones. So rare earths, lithium, nickel, cobalt, graphite, gallium, and geranium. I think I mispronounced geranium. But basically remember that these key critical minerals, which we've spoken a lot on Moomoo about, They're very key to building out all the key components in semiconductors, data centers, AI hardware. And then in the defense space, they're also essential in missiles, drones, radars. And in the EV space, they're critical as well as going into the key nuts and bolts, essentially, of the grid infrastructure that's needed to be the backbone for the EV sector. The third thing that you need to know is the timeline. When on earth is the US going to start buying these critical minerals? Well, the US has actually already started buying these key commodities. They kicked that off in February, and they're going to scale this through quarter by quarter. How much by? Well, 500 million US up to 1 billion per year. That's been earmarked. The fourth thing to know is that Australia is probably going to be a very key benefactor or beneficiary, tomato, of Project Vault. There's already a major partnership that was already announced. We saw that in last year. There's a $3 billion, I guess, partnership that was announced, and that was over a 6-month partnership to build key projects. And the fifth thing that you need to know is the US has announced something this morning, basically proposing to buy critical minerals through a trading bloc. That basically involves 50 countries. So Vice President J.D. Vance wants to basically ensure a couple things, that there are price floors, and all of these key deliveries are made within 6 months. As we said, they're planning to buy quarter on quarter. So what do you need to watch? Well, there's so much to watch. There's so many moving parts. Let's start with the stocks that you might like to keep an eye on in the US. Well, there's USA Rare Earths. That's a major focus for the US government. And this stock is up 92% this year. So it is the Trump administration's expected stock to watch. That's because they're planning to take a 10% stake in the company under a $1.6 billion debt to equity package, really to accelerate USA rare earth production facilities. Another stock to watch, US pure play MP Minerals. That stock's doing really well on the back of these announcements. It's up 15%. And of course, there's mining developers as well that you need to consider. There's many. Just calling out a couple only. I'm well aware that there's so many. And thank you so much for some of you who put the stocks that you're watching in the comments. Keep them coming. But we're just highlighting a couple that are catching our radars. Going back to the mining development space, keep your eye on Critical Minerals Corp. That's up 84% this year. And in the lithium space, lithium space is my baby. I love lithium, have been speaking about it since 2016. Albemarle is up 17% this year. What about Australia? Well, there's plenty stocks that are charging. You've got Brazilian Rare Earths, that rose about 4% yesterday. And then you've got a company called Lavroto Resources that gained 2% on Tuesday, and it's up 22% this year. But some of these stocks that we've mentioned in the critical mineral space, they're actually in some ETFs that you probably do want to keep on your radar. You've got the VanEck Rare Earth and Strategic Metals ETF that follows the Global Rare Earth Strategic Metals Index. And these instruments are up about 16% this year. Across the last 12 months, seen triple-digit gains of about 110%. So it's worth watching all of these stocks, perhaps. Keep your eye on the core theme. For more extrapolation of that, head to Moomoo's platform. Basically, the key takeaway is we do have a very bullish scenario for critical minerals. Now, stocks to add to your watch list. Let's kick off with the Aussie darling in the Australian rare earth stock space. So Lynas shares have done really well of late, moving higher over the last 2 trading sessions. Just yesterday alone, they gained 5%. In fact, this year, they're up almost 30%. So they're around $16 now. But yeah, sure, they're still well under their October peak of $22. But the rebound that we've seen this year has really got a lot of investors sitting up and going, hey, this time around, the Aussie Australian rare earth space looks very competitive, particularly with the Aussie government looking to put in that price floor. And we do have Trump saying that they're looking to, or Trump's administration saying that they're going to buy some of these critical minerals. And Lynas is a key stock to watch. Not only because of this, but because of their own fundamentals. The market was already, to begin with, expecting revenue to climb 90% in 2026. The year after, you're looking at about 49% earnings growth. As I always say, earnings growth drives share price growth. And with this company, are really looking to build their own critical mineral stockpiles, valued at 1.2 billion. Lynas could be a key supplier based on what the Australian government wants to build out. Other local producers that could benefit from the 1.2 billion that's planned by the Australian government include, I don't know how to pronounce this, Arufa and Sunrise Energy. But Lynas also keep something, I guess, on the back burner for you to consider is Lynas is actually searching for a new CEO. Their CEO is about to retire, but over the past 12 months, you could argue that she's had a lot to contribute to the company's almost 145% share price gain. So thank you, Amanda, for your tenure. So where do you go for more information? We'll head to Moomoo's platform. You'll probably see there that 16 analysts have actually covered the stock, and overall consensus is that it is a buy. Over the last week or so, including yesterday, we've seen buy calls reiterated by the heavyweights down under here, like Macquarie and Barrenjoey. Larger names like Morgan Stanley have also reiterated Lynas as a buy. And the narrative is that they're all increasing their price targets. Obviously, when you see a broker or an investment bank increasing their price targets, it's a pretty bullish signal. Let's change to Google parent Alphabet. Their shares moved lower in after-hours trade after they released earnings and spending plans that were above expectations. No one really likes when someone's spending more than expected. So it is worth noting, though, that Google's had a very strong run. It was the strongest performer among the Mag 7 stocks over the past year. It rose 73%. And the gains have continued this year, but they could steady if you believe consensus among Wall Street. The average analyst does only see their share price seeing low single digits this year. So what do you need to know about their results? Well, revenue came in at 114 billion US dollars last quarter. A profit growth hit hit $34 billion. And that was largely driven by a massive surge in their cloud business, with revenue once again surging over 40% year on year. But the concern is what we previously flagged: how much are companies going to spend, and is that going to amplify revenue growth? So this is what the market is questioning now, and that's indeed what is also causing the broad tech sell-off, indeed, in the software space. So the concern is this: Alphabet sees capital expenditure getting as high as 185 billion US this year. So that was well above expectations. So this basically shows you that Alphabet is prepared to spend more than expected, and they're expected to, continue to spend whatever it takes on AI to edge out among other hyperscalers. So maybe they don't have a phenomenal year in terms of share price growth, but I think you should be watching this company for the long term if that is something that you're looking to consider to build out generational wealth, because I can tell you right now, I don't know many other companies that are looking to spend a $185 billion. So you might like to consider taking a long-term view. Anyway, that's up to you. Alphabet does have a buy rating among analysts. Consensus, as I said, sees 7% share price growth in a year. So that's for you to consider. Last but definitely not least, good old Beach Energy. They released their half-year results this morning. Our profit is down 8% for a couple reasons. One of those is basically less production. So they had output being lower because floods disrupted their copper basin. So here we've got Australia's third largest oil and gas player, flat revenue basically. What the market or analysts look at is EBITDA, earnings before interest, tax, depreciation and amortization. EBITDA, they basically fell about 5% year on year, so not too bad. But again, that was on the back of reduced production. But what we need to think about is this an opportunity? Is this a trade? Is this an investment? So what we need to consider is what's ahead. So that 2026 guidance and production, that's expected to be between 19.7 million to 22 million barrels of oil. So that's something you might like to consider when you see the oil price movements across the days and the weeks. But if you do have a look at what the average consensus is among the average analysts, they're saying, hey, this stock is probably going to be a hold. It's not expected to shoot the lights out over the next 12 months. Obviously, that's something to do with the fact that oil supply is expected to be greater than demand. But remember, this company does play in the gas market as well. So maybe this stock should be on your radar. Do keep an eye on a couple of lofty price targets out there. Morningstar reckons Beach Energy could get to $2.60 in a year. Yesterday, it closed at $1.23. And consensus is for their shares to fall 4% in a year and get back to $1.18. But more upside could be ahead, perhaps in the short term, given what we've seen with the natural gas price moving about 5% up overnight amid supply concerns. Plenty to watch and consider. Thanks for staying with me.